He called himself OptionsKing, something on StockTwits. Every morning, without fail, his feed lit up with bold declarations and rocket emojis. He wasn't just talking about companies, he was predicting destinies. Tesla's about to rip, load the calls. Apple to the stratosphere, you're welcome in advance. He wasn't a beginner, at least not in his own mind. He'd had one big win during the electric vehicle boom of 2021, when Tesla soared and his calls tripled in a week. That single trade became his crown jewel, the proof he shared with anyone who doubted him. But here's the danger. One outsized win can blur the line between skill and luck. Last spring, he set his sights on Meta platforms before earnings. He bought short-dated call options, convinced the market was underestimating the rebound in their advertising business. But by Wednesday afternoon, the stock was flat, implied volatility was unwinding, and his premium was melting away like ice under a heat lamp. By Friday, his options had lost over 80% of their value, even though the stock itself barely moved. When I spoke with him afterward, he said something I'll never forget. It's like the market charged me rent for every minute I held those options. That's the hidden truth about options most traders don't fully respect. They're not just a bet on direction, they're a bet on timing. And if you get the timing wrong, the market doesn't need a crash to take your money, it just needs time to pass. Today, I want to walk you through how to avoid that trap and how to use options as a strategic tool instead of a ticking time bomb. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. One of the first books that really opened my eyes to the layered nature of options trading was Getting Started in Options by Michael C. Tomset. Tomset doesn't treat options like a magic money machine. He explains them for what they are, flexible, precise tools that can fit almost any market view or risk appetite. He also makes it clear that the same qualities that make options powerful can just as easily make them dangerous if you don't respect the mechanics. What I appreciated most was how he balanced the technical side with the strategic. Not just how to execute a trade, but how to think about why you're entering it in the first place. It's a mindset shift, one that moves you from chasing the thrill of quick profits to deliberately managing risk and probability. That shift is what I want to bring into today's story. Back in late 2020, I was tracking Adobe. The company had just posted another strong quarter. Demand for creative software was booming, and I believed their subscription model would keep revenue steady no matter what the economy threw at them. I wanted in, but I also wanted flexibility. Instead of buying the stock outright, I bought a Leaps call option with almost 2 years until expiration. It was my way of having a long-term position without tying up a huge chunk of capital. On paper, it was perfect. Defined risk, massive potential upside, and the luxury of time. For the first few months, everything went according to plan. Adobe's stock climbed steadily, and my Leaps gained value faster than the underlying shares. I felt brilliant. But then came the pullback, a 5% drop after a slightly underwhelming earnings report. That's when the psychology kicked in. Even though my thesis hadn't changed, I started second-guessing everything. I watched the position daily, sometimes hourly. Each red candle chipped away at my confidence. I told myself I was protecting my gains, but in reality, I was just reacting to short-term noise. 2 weeks later, I sold for a modest profit. I felt relieved until, of course, the stock reversed and marched to new highs. Had I held to my original plan, that Leaps would have doubled in value within months. The lesson was brutal but clear. Having time on your side doesn't help if you let fear and impatience take control. Options give you leverage over the market, but your emotions can still leverage you right out of a good trade. Since then, I've learned that the real discipline isn't just in picking the right option, it's in holding it when every impulse tells you to bail. Today, we're diving into how to use options as a strategic edge rather than a dangerous gamble. We'll cover why timing matters just as much as direction, how to structure trades so the odds lean in your favor, and how to protect your positions without giving up all your upside. This isn't about chasing the hottest trade on social media. It's about combining smart option strategies with psychological discipline, so you're not just trading the market, you're mastering yourself while you do it. Trading options is like flying a plane. The right controls can give you incredible lift, but a small mistake in timing or judgment can send you into a nosedive before you even see it coming. In getting started in options, Tomset makes an important point. It's not enough to predict direction. The move has to happen before the option expires. That sounds obvious, but in practice, most traders underestimate how much the clock eats away at their edge. I call this the slow bleed trap. You don't notice it in the moment because nothing dramatic happens. The stock drifts sideways, volatility contracts, and each day the option loses a little value. Then one morning you check your account and realize half your premium is gone, without the stock even moving against you. I remember a trader I coached in 2018 who was convinced Netflix was about to rally after a quiet quarter. He bought short-dated calls only 2 weeks out, thinking that would give him plenty of time. But Netflix moved exactly as he predicted, just not on his schedule. The breakout came 3 days after his calls expired worthless. The stock surged, but he wasn't on the ride. Psychology makes this worse. When you know time is running out, you start trading differently. You exit winners too soon, double down on losers, or chase a faster-moving trade to make back what's decaying in your current position. This urgency isn't strategy, it's panic in disguise. Here's a simple mental rule I use. If I think a move will take a month, I buy at least 2 or 3 months of time. That extra time isn't just for the market, it's for my mind. It creates breathing room to stick to my plan without the constant pressure of a ticking clock. Options aren't like stocks. They're wasting assets. Every day you hold them, a little value slips away. Accepting that reality and planning for it is the first step toward using time as an ally instead of letting it quietly drain your account. Tomset explains that buying a put doesn't have to be speculation. It can be insurance, a way to protect a stock you already own. For every 100 shares, you can buy one put contract to define your maximum downside. Think of it like a seatbelt. You hope you don't need it, but when you do, it's priceless. I worked with a trader who owned a large position in Apple during the uncertainty of early 2022. He believed in the company long term, but earnings, announcements, and market headlines were making him restless. He confessed that before every earnings release, he'd hover over the sell button just to avoid the possibility of a big overnight loss. We tried something different. Instead of selling the stock or overreacting to headlines, he bought short-term puts ahead of each earnings event. Some quarters, those puts expired worthless, and he was fine with that. Other times, they paid off big when the stock dropped on weaker than expected guidance. The real change wasn't in his P&L, it was in his psychology. With his downside capped, he stopped making knee-jerk decisions. He held through volatility with a clearer mind, no longer obsessed with every tick. This is the part most traders overlook. Risk management isn't just about protecting capital, it's about protecting your decision-making process. When you know the worst-case scenario, you stop playing defense in your head. You can think bigger, hold longer, and follow your plan without second-guessing yourself. The market rewards clarity, and sometimes the cheapest way to buy clarity is to pay a small premium for protection. Tomset draws a sharp line between selling uncovered calls and selling puts. On paper, both are selling options, but the risk profiles are worlds apart. Selling an uncovered call can be brutal. A stock can rise indefinitely, and every point above your strike is another hit to your account. Selling a put, on the other hand, has a natural flaw. The stock can only fall to zero. That difference matters more than most traders think. A friend of mine learned this the hard way during Amazon's surge in late 2020. He believed the stock was overbought, so he sold uncovered calls a few strikes above the market. The premiums looked incredible. Easy money if Amazon stayed flat. But the rally didn't stop. Within days, the position was deep underwater, and the losses grew with every uptick. He wasn't just losing money, he was trapped, watching the chart like someone stuck in a burning building with no exit. This is why I lean towards selling puts on companies I'd be happy to own at a discount. It's still a commitment. You're agreeing to buy the stock if it falls below your strike, but at least the worst-case outcome is owning something you actually want. Psychologically, that's a huge shift. You're no longer betting against a runaway rally, you're preparing for a scenario you're comfortable with. The trap here is overconfidence. When option premiums look juicy, it's easy to underestimate how fast risk can escalate. Before selling any option, I always ask, am I comfortable with all possible outcomes? If the honest answer is no, I don't sell it. The market doesn't care how confident you feel. It will test your position the moment you let your guard down. The first advanced strategy Thomset introduces is the spread. At its core, a spread is simply opening both a long and a short position in options on the same stock. This can be done with different strike prices, different expiration dates, or both. One of the most common versions is the vertical spread. Same expiration, different strikes. Why do it? Because a spread can reduce your cost and risk while still giving you a shot at a meaningful gain. It's a way to define your maximum loss up front, which is gold for any trader who values peace of mind. But here's where I've seen traders get into trouble. They treat spreads like a risk-free trade. There's no such thing. Yes, the loss is capped, but so is the profit. And that cap can turn into a psychological frustration if the trade moves in your favor more than expected and you're locked out of additional gains. I once worked with a trader who set up a bullish call spread on Microsoft ahead of a product launch. He bought the 250 call and sold the 260 call for the same expiration. The logic was solid: keep costs down, define risk. But Microsoft's rally blew past both strikes within days. He closed the position for the maximum profit the spread allowed, and then spent the next 2 weeks watching the stock keep climbing, calculating how much more he could have made with a naked call. That's the mental trap: regret over missed profits. If you choose a spread, you have to commit to being satisfied with its payoff structure. Otherwise, you'll torture yourself with what-ifs. Here's how I avoid that. Before entering a spread, I visualize the best-case scenario and ask, will I be genuinely happy with this outcome? If the answer is yes, I place the trade. If not, I choose a different structure. Spreads can be a fantastic way to trade with control, but only if your mindset is aligned with their built-in limitations. Otherwise, the very thing that protects you will become the source of your frustration. I've always believed that the market isn't just a place to trade, it's a giant laboratory for human behavior. And when you mix the mechanics of options with trader psychology, you get some fascinating and sometimes sobering patterns. Let's start with the data. In 2019, a behavioral finance study from the University of Chicago analyzed over 100,000 retail option trades. The takeaway was clear. Traders who bought short-term, out-of-the-money options lost money about 76% of the time, and the average loss per trade was more than double the average gain. Why? Because most of them were right about direction less than half the time, and even when they were right, time decay had already eaten their profit. This ties directly back to Thomset's point about timing. You can pick the right company, the right trend, even the right strike, but if you underestimate the time needed for the move to play out, you're stacking the odds against yourself. Real-world example, think back to the meme stock craze of early 2021. I spoke with traders who bought call options on GameStop with expiration just days away, believing they were riding an unstoppable wave. But when the stock pulled back briefly, implied volatility collapsed, and those options lost more than half their value in a single day, even though the stock price itself stayed well above their strike. That's the brutal math of options at work. Another study worth noting came from the CFA Institute in 2020, which looked at professional traders managing equity and option portfolios. They found that traders who used protective puts or defined risk spreads had 18% lower portfolio drawdowns on average during volatile months compared to those who used only directional, unhedged trades. The kicker? Those same traders reported lower stress levels and were less likely to make revenge trades after a loss. Risk management didn't just save their accounts, it saved their decision-making. And here's the part that's hard to quantify but easy to feel. When your risk is defined, your mind is calmer. You're not checking the screen every 5 minutes. You're not glued to news feeds looking for confirmation. You can think clearly and follow your plan, which is exactly what the undisciplined majority fails to do. Markets change, technology changes, but the core psychology driving most traders hasn't changed in decades. And that's why combining Tomset's strategic view with the lessons of behavioral finance is so powerful. It gives you a framework that works with human nature instead of against it. In all my years watching traders work with options, I've noticed that most mistakes aren't born from ignorance of the mechanics. They come from ignoring the psychology. You can memorize every Greek, every expiration cycle, every spread configuration, and still lose money if you fall into the same traps that have claimed countless traders before you. Let's talk about two of the biggest ones I see. Trap 1. Overconfidence. Overconfidence is subtle because it often hides behind a win. A trader hits one big directional trade. Maybe they caught a surge in Nvidia ahead of an earnings blowout, and suddenly they feel untouchable. The problem? They start taking bigger risks with shorter expirations, convinced that their read on the market is special. This is how traders end up loading up on weekly calls or puts with almost no time cushion, believing they can nail the exact day a stock will move. Tomset's warning about timing is especially important here, because overconfidence compresses your time horizon until the odds are stacked almost entirely against you. The market humbles overconfidence faster than anything else. Trap 2. Impatience. If overconfidence is the spark, impatience is the gasoline. Options decay in value over time, and that ticking clock messes with your head. Even traders who start with a solid plan often find themselves bailing out early or chasing a faster setup after just a few days of sideways action. I saw this during the summer of 2022 with a trader who bought a 3-month call spread on Microsoft. The position was fine, the thesis intact, but after 2 weeks of no movement, he closed it for a small loss and jumped into a weekly trade on Tesla just to make something happen. That weekly expired worthless, and the original Microsoft spread would have been a full winner had he just stuck to the plan. Impatience turns potential winners into guaranteed losers. What makes these traps so dangerous is that they feed off each other. Overconfidence pushes you into aggressive trades, impatience pushes you out of good ones. Both are amplified by the unique time pressure of options. The fix? Build guardrails. Use position sizing to keep your confidence in check, and give yourself more time than you think you'll need to fight impatience. And when in doubt, remember, the market doesn't reward the fastest thinker, it rewards the most disciplined. It's one thing to understand the risks and psychology of options trading. It's another to actually put safeguards in place so you don't repeat the same mistakes when the heat is on. Over the years, I've refined a few tools and rules that have helped both me and the traders I've worked with. Tool 1. The double the time rule. If you believe a move will play out in 4 weeks, buy at least 8 weeks of time. This simple adjustment changes everything. It gives you breathing room, reduces the impact of short-term noise, and cuts down the psychological pressure that comes with watching time decay eat your premium. I've yet to see a trader regret having too much time, but I've seen countless ones regret having too little. Tool 2. The position size anchor options can tempt you into going all in because of the smaller capital requirements compared to stocks. To counter this, I use what I call the position size anchor. I size my options trades as if I were buying the equivalent amount of stock outright. For example, if I'd only risk $5,000 on the stock itself, I size my option position so that a total loss would equal no more than that $5,000. This keeps my risk in perspective and stops me from over-leveraging just because options make it easy to do so. Tool 3. Pre-trade visualization. Before I enter an options trade, I take 60 seconds to visualize every possible outcome. If it's a spread, I imagine hitting the maximum gain and ask myself, will I be satisfied or will I feel regret that I didn't go bigger? If it's a naked option, I picture the loss as if it's already happened. If either scenario makes me uneasy, I adjust the trade before I place it. This mental rehearsal helps me commit to the trade without second-guessing once it's live. Rules like these might seem basic, but they're the scaffolding that holds your strategy up when emotions try to pull it apart. Options give you leverage over the market, but without discipline, that leverage will work against you just as fast. Let's pause for a moment and turn the spotlight back on you. Think about your last 5 options trades. Were you right about direction but wrong about timing? Did you choose expirations that gave you enough breathing room, or were you racing the clock? When was the last time you bought protection for a stock position you cared about? And if you haven't, is it because you thought it was a waste of money, or because you were confident nothing bad would happen? Do you size your trades based on the actual risk you're taking, or based on how much you hope to make? Most importantly, how often do you exit a trade early because of impatience, fear, or the temptation of a better setup somewhere else? These aren't just rhetorical questions. Write your answers down. Patterns will emerge, and those patterns will tell you more about your trading psychology than any market chart ever will. The market doesn't just measure price and volume, it measures your patience, discipline, and ability to follow your own rules. If you don't like the answers you find, that's not a failure. It's an opportunity to change the way you trade before the market forces you to. Now it's your turn. Take a few minutes after this video to write down what stood out to you most. Was it the danger of overconfidence, the importance of time, or maybe the realization that protecting your positions can actually free you to think more clearly? Drop your takeaway in the comments. Share this video with a friend who's been struggling with their trading decisions. And if you found this helpful, like, share, and subscribe so we can keep building this community of disciplined, calm, and confident traders. Master your mind. Master the market. Trade with confidence and live with calm.